Welcome to the Major League Real Estate Podcast, a podcast for operators of large-scale real estate portfolios. My name is Nathan Sosa, and I'm your host. Together with my co-host, Matt Hamilton, we talk about tax and legal strategies, and we bring on operators of large portfolios for in-depth discussions on how they grow their business. We hope you enjoy. Welcome to another episode of the Major League Real Estate Podcast. I'm joined again with Matt, my co-host. My name is Nathan Sosa, and we are coming off of a week from 4th of July. And Matt, I don't know what's more patriotic than 4th of July, fireworks, smoking and grilling, right? Matt's about a big smoker and griller. And of course, tax legislation signed on the 4th of July with fighter jets overhead as it's being signed, right? It's like, how can you get more patriotic with tax cuts, right? I don't think there's much better you can do there.
I feel like signing this big piece of legislation on the 4th of July is like the final evolution of that like Schoolhouse Rock song about like
I'm going to try and get that linked in the show notes for anyone who has not seen that. I'm sure everyone has seen it at this point in time, but the best way to ever understand how a bill is going to law doesn't really cover the reconciliation process of how this bill was passed. Unfortunately, maybe a new episode they'll come out with someday, but yeah, Matt. So today's point of the episode is we're going to cover the One Big Beautiful Bill and how it impacts syndicators specifically. So what does that mean, right? It means we're not going to necessarily talk about no tax on overtime, no tax on tips. Syndicators, you guys are not customarily tipped. You don't customarily get paid overtime. So you might work overtime, but unfortunately, you're not going to be able to qualify for that provision. So sorry, but we'll cover the provisions that specifically will address you guys. And so the first one, Matt, that we'll dive into is 100% bonus depreciation and how that is now permanent. There is no fall off. There is no drop off. There is none of that. It is 100% bonus depreciation until Congress decides to turn the tap off. And so tell me how you think that's going to impact syndicators as a whole.
This is going to be huge for syndicators. A lot of my clients specifically, and a lot of syndicators out there, whenever they're pitching to their investors a new investment, they'll usually frame the investment as what benefits do they get immediately from these tax allocations that are coming through on their K1. So, for example, I have one client who's in the RV park space, and RV parks are very heavy on bonus eligible property and a lot of land improvements, right? So what they usually do is they pitch the investment and they say, hey, this is the park. It's a really good investment. And there's a lot of tax incentives as well. If you invest $100,000 in year one, you're going to be allocated, say, $60,000, $70,000 of depreciation losses in year one. So if you have other passive income to offset, this is a huge benefit to you as an investor. And that's a really critical piece of their pitch deck when they're trying to bring on new investors. So really ramping that up back to 100%, making it permanent, it takes a lot of the complication out of that calculation. You have to take into account what percentage that bonus depreciation is anymore. It's streamlined, the most beneficial it can be to the syndicator. It's going to be that way moving forward, which is going to make planning so much easier. So that's
Exactly. It provides so much flexibility with planning now. And that's the biggest game plan, right? We don't have to, like you mentioned, is that we don't have to worry about when these items are placed in service or when the building's placed in service or when construction's completed or when it technically started, right? So one of the big items I want to hit on with the bonus depreciation when it goes into effect is, the first 19 days of the year are not 100% bonus depreciation eligible. I won't tell you what happened on January 20th. You can go look at that, and I'll tell you, being a tax nerd, I thought, it's definitely budgeting purposes, et cetera. They're trying to like rob from Paul, get to bring over to Peter, right, for some various reasons so they can get this bill to be financially solvent or whatever, which it was not. Well, that's a different story. It's a different topic. But, and then someone goes, that's, they thought I was joking. I said, yeah, haha, funny. And I was like, what do you mean? It's like, no, it's because of a certain inauguration day. Regardless, unfortunately, those are the rules we have to play by. This bill is law. And thankfully, we do have some prior guidance that we got from 2017 because this happened then. Not for the same reasons, but basically we had a weird date cutoff. So basically said, okay, what happens to, we had this weird September 27th cutoff. And it's like, okay, what happens to any buildings that were in contract before then or were being constructed before then? What happens there? And so the contract was sent, basically what it says, like, hey, if you had signed contract to purchase a building, purchase property, unfortunately, it doesn't qualify. So whether you actually closed, owned, etc., in that January 1st, 19th timeframe, right? Let's say you sign the contract on January 2nd. Unfortunately, you're trapped with 40% bonus depreciation, right? Unluckiest 2 weeks of the year so far in 2025, but it's an unfortunate piece. Constructed assets are a little different. There's a little bit more that we can look at and try and figure out. And basically what the tax code says is two things we can look at. The first one is basically, when did you get to 10% of construction completion, basically? When did you get to that? So you had 10% of your building construction completed in 2024. That means you're stuck at 60% bonus, even though you might have completed in 2025. However, the other option we can look into is basically, I'm not sure this is a true word, but it's componentizing, right? So basically, we can look at the components of the structure, and then we can say, okay, great. When was that component completed? Oh, construction started, completed, 10% of it was done in 2025, right? So after January 20th, that means it's eligible for 100% bonus depreciation. So I anticipate seeing a lot of weird cost eggs this year. I anticipate seeing a lot of weird cost eggs, looking at when these things are started, being very, very detailed to figure this out, because it can make a big difference. Matt, what are your thoughts on that?
I think it's a very good time to be in the cost seg space if you're a cost seg provider. Is my short answer. But no, I think that's going to create a lot of complications around property acquisition, especially like you were saying, especially if you're in the development space. I've already, and the bill's been passed for like a week, and I have already had a couple clients reach out and say like, hey, I had this property that I acquired or put under contract in like the first 2 weeks of January. What are my options here to like make this bonus eligible? And unfortunately, those options are just really limited. Like Nathan said, those are just the 2.5 most unlucky weeks of 2025 in the tax space if you're specifically in real estate. So your options are very limited. And in most cases, there isn't really much you can do about it, other than, I guess, selling the property and acquiring another one to try again. You know, it's not super great. So that's going to be complicated. Like you said, those cost segs are going to become increasingly complicated, specifically for development projects, as the years kind of blur together if development kind of drags on for a specified period of time. So it'll be really interesting to see how the cost seg space kind of adapts to addressing that specific issue. But it's a very time specific issue. You know, once we get into 2026, this will be in the rearview mirror, and it'll just be 100% bonus depreciation. Things won't be as complicated for this. It's kind of funny to me how complicated this is becoming for a very short window of time. You know,
100%, Matt. That's what I want to focus on too. Is that this is a 1 year glitch, right? And glitch is the word that I'm using just because it's a weird quirk that we're gonna have to deal with only for 2025. All the years after this, never going to exist again. We're never going to care about these rules again, right? Just back in like September of 2017, right? We didn't care about the rules. We just cared about them all the years after that. Just that year is the only time that we cared about those rules. And so it's really strange and weird, but it's just how tax code works sometimes. Sometimes it's 1 year, we have to like work through all these quirks, and then it goes away the next year, right? It's just the way taxes sometimes. So yeah, 100% bonus depreciation. It's coming back. It's going to be really helpful for most people, unless you're in the unluckiest 2 weeks of the year, which I'm sorry, I couldn't have helped you on that because that wasn't said until February. So there's nothing else we could have planned around that. However, there is, if you are not multifamily residential type properties, we can always look into 179 deductions, right? 179 deductions is another option to consider. And 179 got a big boost in this bill. Real estate syndication tax is confusing to you? Well, that's why hopefully you listen to the podcast today. Also, you should go to our website, www.therealestatecpa.com, and you'll be able to get access to the ultimate guide to real estate syndicators and sponsors, which breaks down everything from preferred returns, depreciation strategies, whether you're a GP or an LP, avoid costly mistakes, and maximize your returns. Download the complete guide free and get the tax clarity you need to succeed. 179, for those who are unaware, is basically the older cousin of bonus depreciation, right? It's been around way, way longer, and it's got a lot more rules and limitations behind it. However, since it's the older cousin, it also conforms with the states a lot better than bonus depreciation does, right? States take a long time to conform, or somewhat even straight up decided they did not want to conform. And so there's another option there, and they got a big boost, right? So previously, you could only expense $1.5 million of 179 property, which for syndicators, that's not a whole lot of depreciation sometimes. But in this case, it got a boost to $2.5 million. So that's a massive boost here, and that's a lot more expensing probabilities. The other issue with 179 is also there are phase-in limitations where you essentially, maybe you might get phased out of being able to have the ability to use that. So that cap was $2.5 million of like, if you have quote unquote eligible 179 property, right? Because you elect into 179, we have to elect out of bonus depreciation. But that cap got raised from $2.5 million to $4 million. So now there's a lot more of 179 eligible property that we can use to expense here. And that's actually a big win in my opinion. It gives us more flexibility and options to use this. Matt, do you think that's going to be helpful for syndicators too?
Yeah, I think it'll be helpful specifically in bridging the gap for any property in that like sort of gray area. Because I think oftentimes 179 isn't a huge consideration for a lot of these syndicators because bonus depreciation, especially now that bonus depreciation is back at 100%, it's less of a consideration because generally speaking, bonus depreciation is more advantageous. There aren't as many limitations to it. So I think bonus depreciation will continue to be the primary driver of those losses for many syndicators. But as we're kind of bridging the gap, if you had property that was placed in service in early January or development projects that kind of span from 24 to 25 and kind of create that weird gray area, it's really important to reach out to your tax professional, your CPA, and just ask if 179 deductions are a possibility to supplement some of the bonus depreciation deductions you might experience as you're kind of transitioning from 24 to 25.
Yeah, that's a great point, Matt. And so yeah, 179 versus bonus depreciation. Obviously, bonus depreciation is easier, but one of the things too is that, like we're talking about in a second, sometimes we have to elect into what's called ADS, and sometimes we have to use that in certain circumstances. I think that's going to become less because of another provision we're going to talk about, but you can use 179 with ADS. And so that's like, yeah, so like granted, now that might not make the most sense for most commercial properties for various reasons to have to do that. However, just FYI, that is an option for you if you have to use ADS, right? 179 is the older cousin. It's not as friendly as bonus depreciation. Funnily enough, every year we've gone to basically a 40% bonus depreciation year. That's when Congress decided to get their act in gear, right? In 2017, 2018, the bonus depreciation was going to fall to 40%. Congress got their act in gear. Guess what? 2025 was supposed to be 40%. Congress got their act in gear again. So, and this is something that we're going to talk about later too, is that we're getting closer and closer, in my opinion, to where Congress wants the tax code to just basically be, you purchase an asset, you get to expense it immediately, regardless of what it is, how big it is, etc. We're getting closer and closer to that, in my opinion. And there's provisions in this bill that are getting us that way. Economists love that idea. Congress people love that idea since we're moving into very high inflationary times. So it just helps a little bit with the economics of the system of what we're currently dealing with. We'll see how quickly we get there. We're going to see a reconciliation 2.0 coming in the next maybe year. We'll see if they can get everybody on board with the Republicans before the next election happens. So that's a little teaser. I'll have a, at the end of every sports season, there's a too soon prediction, right? Guess what? I'll be writing a too soon prediction on what's going to happen in the second reconciliation with the Trump administration. But aside from that, what we're going to talk about next is interest expensing, right? And all of you go, well, what do you mean? I always expense my interest anyways, so I don't understand what's happening here. Well, there was this little quirk that came into play in 2022. And so in TCJA had a ton of, I won't call them trip mines, but they used a lot of items to basically pay for certain things. And basically, we'll fix it when we get there, right? We'll get reelected in the next administration. Everything will be hunky-dory. And guess what? That's not what happened. And so we got split Congress, and split Congress is very ineffective at getting bipartisan legislation done. And because of that, a lot of these expiring provisions expired. And so starting in 2022, you were forced to look at your interest expensing calculation. Basically, you have this, what is called adjusted taxable income. And you look at that, and then you say, okay, I've got adjusted taxable income. Now I take that times 30%, and whatever that number is, let's just say it's $1 million of adjusted taxable income. I take that times 30%. I get to deduct $300,000 interest expense. Double thumbs up. Previously, that calculation looked at earnings before interest and taxes. And then after 2022, that calculation changed. And then it flipped to EBITDA, which is not favorable in real estate because now it's earnings before interest, or maybe I'm saying this backwards, but it looked at depreciation and amortization and basically knocked us down to where we have a lower threshold to deduct interest expense. And Matt, in your experience, I believe that we have to do a lot of 163J interest elections, which forces us to flip to ADS. Tell me a little bit about that and how that works actually.
Yeah, so over the last couple of years, as that calculation has flipped, a lot of real estate syndications, a lot of real estate partnerships have become, well, their losses are always very depreciation dependent. So if you were to remove depreciation or add depreciation to that calculation to limit your interest expense, what happens is the depreciation oftentimes pushes the partnership out of the eligibility to actually deduct their mortgage interest expense, which obviously is not ideal, especially if you have these large property with multi-million dollar mortgages. That's hundreds of thousands of dollars of deductions a year in interest. So what you can do is you can make an election to elect out of the 163J limitation, but the trade-off is that you have to depreciate your property using ADS instead of makers. So that means that your 39-year property is depreciated over 40 years. And the depreciation is less accelerated. 27.5-year property becomes a 30-year property. And it also prevents bonus depreciation on certain typically bonus eligible property. So that's another consideration as well. If you're running commercial properties, tenant improvements, the deductibility of that becomes more strict. So oftentimes these elections are not advantageous for certain classes of property. But whenever we run into the situation, we run what's called a 163J analysis. And effectively what we do is we look at two scenarios. Scenario one, you don't make the election, your interest expense is limited. Scenario two, you make the election, your depreciation is lessened, but you can deduct your interest. And we ask ourselves, which one of these scenarios is greater in the short term and the long term? So in the short term, maybe deducting your interest gets you an extra, let's say, $200,000 of deductions in year one. And let's say you're running a multifamily property and there really isn't too much. There aren't really many tenant improvements or land improvements that would limit your bonus depreciation down the road. So it kind of becomes a no-brainer to make the election. Use ADS instead of makers, and then you get to deduct your mortgage interest. So that's kind of what we've been doing in the past. But now that becomes less and less relevant because if we're not taking depreciation into account, interest expense is going to become less interested or less limited.
We'll be less interested in limitations.
Interest expense will be less interested in becoming limited by its own.
That was great.
But yeah, no. So that's going to become less and less common having to make those elections. But it is worth noting that making that election is irrevocable, meaning that if that election has been made in the past, you can't undo it. So you're stuck using the ADS method moving forward, even though it's no longer necessary to deduct that mortgage interest. So that's just something to be aware of.
Yeah, so that's unfortunately, if you had to do it in the past because those prior years, you're stuck. But if you have new syndications coming up, right, that's the thing about the syndication world is that like nothing's permanent, no fund is permanent, no fund's gonna very rarely run forever. So you're not gonna be trapped, and in future years you'll be able to avoid having to be forced into this election like we previously were. So that's fantastic. It just gives us more opportunities. Matt, I want to talk quickly about some things that were not in the bill, and then we'll probably wrap up on this one big provision that I feel like will be interesting to see. I'm really curious to see what syndicators are going to do in the future with it. But we'll talk about carried interest, right? That was definitely discussed very early on. It was actually one of Trump's favorite priorities that he was like, I want this gone. And then slowly walked that back as time went on. And it's like carried interest, limitations, getting rid of it didn't happen. So nothing that syndicators need to worry about or think about there. That didn't come through. So that's a good thing, right? We don't have to worry about that any longer. So we're good to go there. The second item is pass-through entity tax deductions. These are state deductions. That also, there's initially and very early drafts. This is a big thing, right? It's like if you read early drafts and read information about early drafts, that's great. Just remember that Congress changes its mind pretty frequently as they have to go through negotiations through this process. And ultimately, there were changes to it in the House passed bill. There were changes to it in the first version of the Senate bill. And then guess what happened in the final bill? Nothing. So pass-through entity tax deductions for any syndicators or anyone who runs a pass-through entity, that's still here. It's not gone. It's not gotten rid of, right? And then quick aside to that too, SALT cap. So right now, everyone gets to deduct only $10,000 state and local income tax, right? It also includes property tax, real estate taxes, etc. So that means that cap's gone as well. So now you get to double dip almost, right? So you're probably not going to double dip unless you are in a really high tax state. I would imagine probably not, but there's just more opportunity, more planning and playing around. What's interesting, a lot of these state provisions, some of them sunset in 2025. It'll be interesting to see what the states do legislation-wise And if they want to change this, modify this, etc. I don't know what they're going to do, but we'll have to see what happens. For California, for example, expires in 2025. I would imagine they'll pass that. Governor Newsom's already talked about doing that. We'll see what happens, right? I know it doesn't say apply to all syndicators here, but it can apply to some. So I wanted to address that real quick. And then, Matt, this is kind of, I guess it's becoming my favorite provision in the bill just because it's so new and so interesting. So all of you know, we've talked about in our What is Depreciation episode, there's that 39-year portion of your building that you, like we talked about, guess what? Sorry, you can't deduct this. You can't write it off. You have to depreciate this big item over a long period of life, right? In this tax bill, we get the first opportunity where you get to expense that, just like you would with bonus depreciation in the first year you get it placed in service. There are rules and limitations around it, but it's called qualified production property. So this is not necessarily in the normal real estate realm, but basically, if you have what is a production plant, manufacturing plant, and you're looking to purchase it, that's one of the key points. You have to purchase and place in service after July 4th. You can expense the entire 39 portion of that building. So I say the entire portion, anything that's related to the manufacturing process, which in a factory is the biggest portion of that building, right? Matt, what are some ways you think syndicators might get crazy or think about this?
I think this will be really interesting for a couple of reasons. One, because traditionally, industrial property is not a super popular asset class amongst syndicators. There are some people in that niche, but oftentimes it's a very difficult niche to operate in because it requires a high level of occupancy from oftentimes one or maybe two tenants. So it becomes very volatile if something were to happen to the manufacturing space in that specific geography. It's a riskier asset class. But I think adding this potential benefit of being able to deduct, effectively take 100% bonus depreciation on the entire value of the property minus the land, I think that will create an interesting incentive to see if this niche sees a lot more use and a lot more investment over the next couple of years, because it makes it easier to raise capital. Because like I was saying earlier, if you have in your pitch deck the tax benefits of making this investment, there's two sides. There's the economic benefits of investing in this property, whether or not the property's going to do super well, appreciate in value, generate a ton of cash flow. That necessarily doesn't change with the incentives in manufacturing and production. But if you can supplement that by throwing in additional tax benefits and saying this is the most tax efficient passive investment you can make in real estate, then maybe that can outweigh some of the economic risks of investing in that type of property. So it'll be really interesting to see how that changes the space and if industrial and manufacturing facilities become more common in these larger syndications.
Yeah, I'll be curious to see how that winds up happening too. One specific provision in the bill, just so you won't be able initially I was thinking about this, is that syndicators are I'm just going to purchase a factory and then let an operator come in and run the business. That won't be allowed. That will make it not qualified production property if you just do that. Now, I wonder, and we'll have to see what happens in the regulations. I'm sure there'll be some clauses and whatnot, like whether it's ownership, etc. You can probably, with an operator, having LPs and funds, etc., own it jointly together. That would be my assumption, is how that you can make that work, right? Just it's a normal GP structure, an honest opinion. And so you should have an operator who's taking care of that with all the other LPs who are helping fund it. So we'll see what happens. You just can't lease it out to somebody else, right? You can't purchase a big factory or remodel a factory and say, hey, you come in, you can buy it from me and you operate this thing, right? They're not looking to do that. They're looking for the person who owns it to also be the operator. So we'll see what happens there, Matt. I don't know. I think it's an insanely interesting provision because let's say it's a $5 million factory, right? We'll say $5 million in total cost, right? And you do the cost egg and whatnot, and you find out $2 million is your 39-year property, right? Which is very likely. That's $2 million expense in that year. That's kind of massive in my opinion. Now, granted, if you go, I hate being in the factory space, we're going to turn this thing into something else. It's going to be a warehouse, right? Industrial, everyone loves industrial storage right now, and you decide to flip it to that. That's where it gets really tricky because now, essentially, this qualified property is viewed as 1245 property, which Matt and I talked about in the depreciation episode, which means anything that you sell is going to be taxed at ordinary income. So if you take it out of its qualified production property purpose, guess what? You just create an income event with zero cash on hand because you have to be forced on that taxation if it's within 10 years of you running it, right? If you run it for 10 years, no problem. If you run it for 10 years and then flip it out, you are not taxed on that event, right? If you do it in year 12, you're not taxed on that event. But if you do it before a decade of running the factory, then you get hit with that massive income event, and your LPs and syndicators are going to be real happy with you, having basically no cash on hand to pay the tax that's associated with that. So I thought that was an interesting provision. Any thoughts on that one, Matt?
Yeah, no, I mean, it's just something to be aware of in just kind of changing the purpose of the property, right? So it's, like I said, it's not a super common niche for a lot of syndicators. It's going to be super impactful for people who are in the niche. And my understanding is that this incentive is largely aimed at manufacturing companies to make it more profitable to operate their actual manufacturing facilities in the United States instead of outsourcing it to, say, China, India, and other places in the world. So it'll be really interesting for them because it allows them to operate with a huge net operating loss from year one, being able to deduct the entire value of their property minus the land. So that'll be really great. But like you said, I think there's going to be some really interesting opportunity to structure different deals around that property to help team up with manufacturing companies to offer LP capital to acquire facilities they may not be able to acquire on their own. So I think it's going to open the door to partnerships in the space that traditionally haven't really existed very much in the past. And it's going to become a more popular option because of these tax incentives specifically. So that'll be really interesting to see.
Yeah, like I said, all the rules aren't out for this yet. So like we're going to get stuff from Treasury in the next 3 to 6 months. Hopefully, like not hopefully, we will, because they have no choice. They're required by law. So whether it's good proposed regulations or bad proposed regulations, we'll see. But we'll be getting more information, figure out how these quirks actually work, because there's the letter of the law and then there's the interpretation of the law that we have to work with Treasury on. So it'll be interesting to see. But Matt, anything else from what you've seen from the bill that you think is intriguing or syndicators should think about, know about?
Yeah, I'm going to say my first thought after reading through the bill, I just envisioned the no tax on tips section of the bill. My mind immediately went to syndicators. The GPs, they're running the operation. Every time they distribute cash to their investors, they hand deliver it and then flip over the iPad and then just like ask for operating the partnership. So now that's a new tax loophole. So, instead of giving yourself asset management fees or fees for acquiring the property or operating the partnership, just,
what would you call that? A 250% tip or like a 250% tip, 300% tip?
I definitely wouldn't start at like 10, 15, 20. I would definitely start at like, 50, 75, 100. Because look, I mean, you're delivering, especially if it's doing really well, you're delivering pretty big distributions, right? So, I mean, like
correct.
Honestly, you could do a 10%. If you got a 10% tip on every distribution that you get, that's a pretty sick deal. So
it would be too bad they're not going to qualify based on the legislation, unfortunately. Actually, two things that I want to just hit on real fast. QOZs, qualified opportunity zones, do remain in existence. They are made permanent as well. So they are going to continue being a part of the tax code. They're not going away. They are somewhat changed the rules a little bit. So unfortunately, if you have a QOZ and you're hoping for relief on your 2026 gain, sorry, that's still a recognition year. You got to pay that tax in 2027. However, still got time to plan. The new QOZ rules start January 1st, 2027. So we still have a little bit of time and before that actually winds up rolling out. And basically what happens now is these zones exist for 10 years. And then we do a new cycle basically. So thankfully, most of these funds are open. Sometimes they're closed, but you can invest your capital gains. Let's just say year one. You're not required to do it year one, but you do it in year one. And you hold for 5 years. That's now your income event. Your income event is going to be after the first 5 years. So the capital gains, you kick down the road for 5 years. You're going to recognize that 5 years after your deferral. After you hold for 5 years, that's when you get a 10% step up in basis, unless you're a rural QOZ, which is specific rules on that. We don't have time to dive into those today. We will do a podcast on that. And it's basically you get a 30% step up after 5 years. The 10-year hold election, right? So you decide you want to hold and then sell your investment after 10 years, and you get to basically escape all depreciation, recapture, and gain with the fair market value step up, right? You only get step ups at death. This is the only other way you can get a step up before you die. So just unless you're like various other ways without having to put cash in, right? So just FYI there, you can do that. And then there's a forced step up at year 30, right? So if you find the best QOZ investment of all time and you hold that for 30 years, we have some clients that have some of their own that are doing that. That's probably going to make sense for. At 30 years, that is your forced depreciation step up. You still have the option between years 10 through 30 to make the election and do it. But just FYI, that exists for you guys. Rural areas got a big boost, essentially. Substantial improvement is actually cut in half. You don't have to do 100% improvements now. It's 50%. So that's actually beneficial here, is that you don't have to double the basis of the property. All you have to do is just get a 50% increase on this. So they're really looking for rural investments here. So we'll figure out what that looks like and what those tracks get designated in the future. QSBS got some expansion. I know some syndicators might dabble with that stuff. Just there's more easy off-ramps. There's a year 3, 4, and 5 exclusion. So just FYI there, that exists for you guys. You can utilize that and take advantage of it. But Matt, any thoughts on those two provisions before we jump off for today?
I think with qualified opportunity zones specifically, I think diving into that in a future topic in more detail is really going to be beneficial. There's a lot of moving parts there, and it's really interesting to see that be made permanent with multiple tranches and kind of expanding that out, and what that looks like in the future with those changes to rural areas and the changes to required deployment of capital and improvement properties. So like that'll be really interesting to see. And I think diving into that in a future topic, because we could probably go on for that for like another 30 minutes. So it probably doesn't make sense to do that now, but that'll be really interesting.
Yeah, guys, we're going to be having tons of content so we've got a full big breakdown of the bill. You can go to our bill tracker 2025 on our website at www.therealestatecpa.com. And you'll be able to look at that there. Highly recommend it. We're going to have multiple articles and strategies for syndicators coming out on how you guys can utilize this stuff, the rules behind it, with the bonus depreciation and whatnot. So go there. If you want to work with Matt or I, click in the show note links. We've got links there for you guys to easily access and jump into. So thank you guys for listening. And this has been another episode of the Major Real Estate Podcast.